Good day, friends! In this video, I want to tell you about a very interesting strategy, the wheel, which allows you to generate constant profit. In previous videos, I looked at strategies that allow you to sell expensive, covered call option. I've also made videos on a strategy that allows you to buy cheap through selling put options. But the wheel strategy combines out-of-the-option put option sales and covered call option sales. Be sure to watch this video to the end. Otherwise, you won't understand how this strategy works, about its profitability and risks, which is the most important thing. Let's say we're working with an option series that has 2 weeks left to expiration. The Bitcoin futures price, for example, is 26,640. We're interested in options that still have a good premium. For example, put options of strike 25,500. You can work with any number of contracts, but I choose 1,000 to make it easier to count everything. 1,000 contracts is 1 Bitcoin. Here's what my P&L looks like. By selling 1,000 put options of strike 25,500, and we know that if the asset price does not fall below the break-even point, somewhere around 25,250, we will make a profit. If the expiration happens above the strike price, we will get the option premium. What will our profit be? $285. But if the price goes below the strike price, the option goes in the money, we get a Bitcoin futures worth of 25,500. Is that a good price? I think it's not a bad price. Cheaper than the market price of 26,640. If the price doesn't fall and doesn't appear below the strike price of 25,500, then we make a profit. But what happens if the price keeps falling and falling? We get a delivery of futures worth, I'm going to enter the data here now, 25,500. The quantity is 1,000 contracts. Look at this interesting picture. On this line here, I'm going to enter a price of 25,500, but it could be lower. Okay, we've received the futures. What do we do with it? We can sell call options of this Bitcoin futures. Just a reminder, I'm now just modeling the situation as if delivery occurred. I will not use the next series. I will demonstrate everything with the current series. In a real-world situation, I would have to take next month's options. The best choices are 2 weeks to a month out. These series have very good time premium, and we can take advantage of that. Then we are against our futures that we got at 25,500, selling call options of strike 26,500. And now it's very important to understand what our price is going to be. In this line, I changed the price to 25,500. The theoretical price is 282, so in this line, I changed the price to 282. I sell 1,000 contracts, and look at the resulting strategy. It's a covered sale. In the event that the sold call options do not go into the money at expiration, we will still have our futures, and we will receive the premium of the sold options. Double 282. But if the price rises above strike 26,500, the options will go into the money, and at expiration, options will collapse. A delivery of 1,000 futures, short sale will occur, and along with our futures will collapse. And then we will make a profit if the price comes back up from selling the put options, $285, and another $282 from selling the call options minus the commission, of course. And after that, we start another round. Again, we sell put options. Again, we make a profit. If we're sitting on a futures that doesn't execute, we go on and keep selling call options. That's why the strategy is called a wheel, because the cycle repeats in a circle over and over again. We are either selling put options out of the money, or we are selling covered call options. And all the while, we are making profit from the time premium. The profitability depends on the strike. The more strikes are in the money, the greater the time premium. What are the risks? The risk is that the price may drop significantly, and then we will have to sell call options for a very long time because we need to cover the loss we got with the futures. But in this case, there's a plus side, which is an increase in volatility, and then those call options will be quite expensive. This is the kind of strategy that is suitable for investors of Bitcoin futures or other asset. It is better to choose an asset with high volatility, then the profit will be higher. And that's all for now. Please ask your questions in the comments. Subscribe to the channel if you haven't already. I wish you all the best and, of course, successful options trading.